Hey, welcome back to The Dive. Today on the show, we have the global market analyst at Crescat Capital, Tavi Costa. He's joining us today to talk about Silicon Valley Bank failing and some of the repercussions, the Fed's next move. He's also going to go over some of his interesting charts, and be sure to stick around till the end to hear where he sees opportunities in this environment. Hey, Tavi, welcome back to The Dive. Thank you so much for joining us today.
Thanks for having me.
Okay, so Tavi, we have to get your thoughts on Silicon Valley Bank. The Fed announced a $25 billion funding program for banks to meet the needs of all of their depositors. How closely are you following this, and do you think that the Fed should have stepped in?
That's an important question, I guess, if the Fed should or should not. However, I do think it's extremely relevant to what's going on. I mean, in a sense, the Fed basically bailed out an issue that happened in financial markets, which is, in a way, reminds us of other times when they had to do the same in order to inject liquidity into the system. One thing, though, that is important to know that I noted recently is the fact that when you look at the government cash balance currently, it's running very low in that. And so that is a source of liquidity for the economy overall. And so if, with the debt ceiling issue and so forth, the Fed might have to step in order to really finance some of the issues that we're having with the government too. So it is crazy to say this, but even with what's happening recently, I don't think we've seen at all when it comes to the amount of stimulative package required by the government and the Federal Reserve will need in order to not cause a lot of issues. And it's sort of in the back of where interest rates are currently, just staying above 4%, between 4 to 6% range is, I think, very problematic. It's where you start seeing some of the folks that are actually swimming naked to, as Warren Buffett likes to say. And so we are certainly beginning to see some of those issues emerging now. And I think it is problematic. Credit spreads are beginning to blow out. And that is, in my view, one of the biggest risks in markets today is that corporate bonds are very overvalued. And so it's all, in a way, interconnected with this issue that is happening with counterparty risk and other issues with the banks. Do I think that the SVB bank itself is potentially systemic? I don't think it is. I don't think it's as systemic as the markets are thinking. I think markets are sort of, in a way, almost fighting the less war because we tend to think that what happened in 08 will happen again today, and the causes of that crisis will be the same. But I don't share that view. I think will be a little bit different, especially with the recently, again, treasuries have been rallying and other things. But I think the bigger risk of things is in the front of is still an inflationary environment where cost of capital will stay higher for longer. And if that's the case, what does that do to multiples in equity markets, mega cap stocks that still trade at very hefty multiples, corporate bonds, private equity? I mean, if you just look at the what we've had so far of writing some of the prices of those assets that the banks had in their balance sheet down. I mean, imagine what would that really happen in the private equity space if they would value their assets up properly. So there's a lot of questions here, and I think there's still a lot of risk in the economy because of where we are. Clearly, financial conditions are too tight for assets that are near record valuations, but also too loose for where inflationary forces are, especially if they are supposedly secular, which is my view.
Do you think that the Fed is done with increasing rates?
I think that it will pause. Now, this view that the Fed will cut interest rates, I don't share that. But that doesn't really, I mean, it could matter. If the Fed cut interest rates, it could, create another, especially if if it creates a path towards um, lowering rates significantly, I think it would change the whole setup. If they just pause, which is my base case, I don't think it would change much the constraints that we're seeing, or at least the pressure coming from financial conditions is still tightening, because it's important to remember there's a lot of variables when you think about liquidity. And one of them is the government, is the cash balance of the government. So the higher the cash balance, when they draw those balances, essentially what you see is that liquidity coming into the space. And the second part of this is the QT itself, which is the reduction of assets in the Fed's balance sheet. And you have to look at those in combination. Recently, since the QT started, I think the decline was over $400 billion in the Fed's balance sheet assets. However, that has been basically offset by about $600 billion of injection coming from the government cash balance side. Now, the government cash balance, as I said earlier, is running low. So there's not much room for this injection of liquidity. And the next step for the government would be putting the debt ceiling aside, which I don't think would be a real concern. I think we'll get past by that if we needed to. It would be that the government would have to basically issue a significant amount of treasuries in order to fund its government, because the deficit that we're having on the government front is significant still. And therefore, if the government is not making enough revenues to pay for its expenses, that means they're, by definition, having a deficit. Then in order to fund their own operations, they have to issue treasuries. And that's a domino effect, because that dynamic creates pressure and yields to rise. And so would the Fed step in here, on top of the Fed actually not being a buyer of treasuries recently? In fact, they're letting their balance sheet actually mature, which means it's the quantitative tightening that policy that they established months ago. And so I think those are all very important questions from a liquidity front in markets, and why I think this is not a wait. This is much worse than a wait. And I don't think it's so much through the banks this time, but other issues that we have that are potentially much worse than a wait. And that is the private equity side, the valuation of markets that's still very frothy, the way investors are conditioned to value assets in an environment of high growth and low cost of capital, which I also don't believe will be the case. All that is playing a role into, what's happening recently. And I think there's a lot more unfolding here.
Okay, so since we're talking about the Fed, could we pull up your Fed balance sheet versus bond market performance chart? And could you walk us through it?
Yeah, well, that chart is relevant because since a lot of analysis has been done about the available for sale versus held to maturity assets in most of the balance sheets of the banks, essentially what you're seeing is that the decline of value of those assets wasn't being reflected in their balance sheet, and therefore folks were not seeing the real unrealized loss in those assets. Now, the big elephant in the room here is that despite the fact that we do have those issues occurring with the U.S. banks, particularly, even the larger banks, but really the regional banks are the ones really taking most of the burden. What you're seeing as well is that the Federal Reserve's balance sheet actually is completely overstated. They also don't mark to market their own balance sheet, and therefore if you calculate, just do a normal calculation of the value decline of mortgages, mortgage-backed securities, along with the U.S. Treasuries, using duration calculations and so forth, what you find is that the actual declining value of the Fed's balance sheet has been close to $1.5 trillion. So when you think about quantitative tightening, and this is a thing that we haven't really thought about it because it hasn't really happened since the Fed's role into financial markets of having such a large balance sheet, and intervening as much as they have been over the last decades. But if you think about this, how much liquidity has been withdrawn of the market by this moving U.S. Treasuries that we've had over the last 1 to 2 years? Because if the Fed doesn't have as much assets as they claim they have, just like the banks, then has QT be more aggressive than what has been announced? It's a fair question. And so I think that's the elephant in the room that I was referred to, which I don't think the Fed has the same level of liquidity that the market perceives as if they do. And so that's a problem. So that's why I use that chart to explain this sort of thesis behind something that is related to the banks and the issues that we're seeing, but also related to the Federal Reserve.
Okay, so let's move on and talk about inflation. What does your monthly change in 1-year inflation expectations chart tell us? And why do you think it's relevant to the market today?
Well, it's less relevant than it was a while ago, but it's still very relevant. And by that, I mean, before we had this financial conditions really tightening in the last week, and this is given the fact of all that's been happening with credit spreads and the issues with the banks in the U.S. and so forth, which is a new development. Up until last week, inflation expectation, or the break-even rate, which is calculated basically by the market expectation of where CPI is likely to be at a certain duration. I believe in that chart I use a 1-year duration. And what you find is that despite the fact that the Fed has been raising rates, inflation expectations have actually been moving higher. Now, more recently, they've gone the other way. And that was because we've had a credit event in markets. But it's important to know that, it is still very relevant, because what's happening is that we do have the 4 pillars of inflation still functioning in the economy in a large way. The wages and salaries growth is an important aspect. You still have this lack of materials, especially from the chronic underinvestments in commodities. You still have fiscal spending being reckless. Therefore, why the government is running its cash balance so low. And we're still having this deglobalization patterns intensifying over time, which all play a role into creating long-term inflationary pressure in not only the U.S. economy, but really in the global economy. And so it's hard to believe that either you have a hard landing like we're having in the last, week or so kind of scenario, which I don't know if will last for a long time here, but either we're going to have, real hard landing like we're having with a lot of credit events and issues like we're seeing, where inflation comes back to, to historically elevated levels again. And if that's the case, then the Fed is really trapped. And that is the one thing we all know, is that the Fed is truly trapped, because if you think about it, you will still need a financially repressed environment. We still require that to be the case. And the reason for that is because of the amount of debt that we have in the system, but also the valuation problem that we have in financial markets. I mean, do we want to have another Great Depression? If we do, if cost of capital stays high and interest rates stay high, then valuations are completely off to the current levels, and prices need to reflect that environment in a big way. And if that's the case, we're talking, very significant double digits declines in overall markets, which means some other single companies might be down, might be even out of businesses. And so note that we're seeing this bankruptcy numbers begin to rise. Delinquency rates across consumers, credit card delinquency rates are starting to rise as well. That's not because the economy is in a healthy place. It's just because we have way too many imbalances, historical imbalances, and there's only so much the Fed can really do. They were doing all this until things started to break, and guess what? We just had a credit event recently that is a sign that things are starting to break. So, yeah, I think inflation is, despite the fact that over this last week or so is not so much on the news, inflation is historically elevated and it's here to stay, in my view. It's going to be wavy, meaning it will accelerate, and accelerate again, but it's not going to be a cyclical type of inflation. It's going to be very structural, in my view. And if that's the case, again, it raises a lot of questions for multiples, especially in equity markets that are still very, very expensive.
What about the top 10 largest U.S. stocks free cash flow growth chart? You mentioned that mega caps recently reported their worst free cash flow loss in 25 years. Do you think investors should be concerned?
Yes, because that's the highest duration types of assets. They're high duration because analysts and investors begin to extrapolate that a business like Amazon will be generating free cash flow for the next 10, 20, 30 years. And so they apply a discount rate, and by discounting that cash flow, they will figure out what's the present value of that asset. But the problem is that is assuming a growth that we've had over the last decade or so. The 2010s, which was the prior decade, was the strongest corporate growth in real terms that we've had in history. Every other decade that we've had is strong growth, which was preceded the Great Depression and also preceded the tech bust and the global financial crisis decades. In other words, the 1990s and also the 1920s. Both of those decades were also on the back of a lot of speculation and so forth. And by the end of those decades, obviously, analysts that had lived through that period extrapolated that thesis that we would have another 10 years of the same environment. But that very rarely happens. And if you look at today's corporate growth in terms of profits, it's on pace to be the second best in history. So basically, we're assuming we're going to have not only the best one in the prior 10 years, but now the second best in the next 10 years. And I really doubt that that's going to be the case. There's a lot of reasons for that. I mean, first of all, I think that wages and salaries will play a bigger role into this. They're very inelastic. And when they start growing, it's very hard to reverse those trends. And those trends are intensifying over time in nominal terms in particular. And if you look at the amount of cost, operational cost, relative to revenues over in the 70s and other times when wages and salaries actually started to pick up, you can see that that was a much larger percentage of corporate profits. In other words, it was eating up the bottom line of most of those businesses. And today, we're not seeing that yet, and we're starting to see that. Operating margin right now is down, call it 30% or so since its peak. And we're still seeing analyst estimates at about 50 to 20% for earnings 2 years out, and I just don't think that will be the case. And so there's a lot of adjustments that need to happen here, and the big tech names and the big market cap companies are at risk because their valuations is completely, not in line with this potential scenario where macro drivers for equity markets will be very challenging. And if that's the case, then you don't want to put I think the top 5 companies is with a multiple of 29 times free cash flow today, and 26 times free cash flow for the top 10, which is just absurd. I really doubt it's going to be the case that in 10 years from now, the top 10 companies will have those multiples. I don't think it will be the case. And so there's an opportunity here as well for shorting some of those companies, and that's what we've been doing.
Okay, so let's shift to oil here. Saudi Arabia's state-controlled oil giant Aramco posted a record net income of $161 billion for 2022, 47% higher over the year. And you mentioned in one of your charts that oil is at an important level close to a short-term breakout. Do you think oil prices are going higher?
Well, when I said that was before bank runs, which I had no idea were going to happen a week ago. I still believe that we're going to see higher oil prices. I still believe oil prices are very low. I still think this is not a wait. I still think that the reason for that is really looking at the CapEx, aggregate capital spending for the overall commodity space. And you look at the energy companies, you still see the fact that their CapEx trend is still historically depressed. And when you look back in 2008, it was the opposite of that, where we were at a peak levels of spending, very exuberant type of market with a lot of frothy valuations and companies doing a lot of M&A activity. And I don't think this is what's happening today. There is a cyclicality aspect to oil prices that I think is normal to see in an environment that we're seeing recently, which is the overall market pricing in correlations like we saw in 2008, where treasuries are rallying, everything else is falling, gold is actually rallying. And so you're seeing a lot of similarities with 2008 correlations in the last week or so, but the market is not made by a week, and it's usually volatility creates opportunities. And so if you ask me where I think this market is potentially wrong, and where if I had capital to be deploying right now, where I would be looking to deploy, would be to add a prudent amount of capital into the energy space. That's all. But that's just my opinion. I know a lot of people disagree with this, and it's easy to disagree with this call, especially right now, because the news are just so negative for the overall economy. We're going to see a recession. Therefore, oil prices will decline. But in the 73, 74 times when we've had a inflationary-driven correction, which was very similar to now, where inflation just being historically elevated caused the Fed to actually have interest rates higher, not lower. Doesn't mean raising, just means at a certain level that is high enough to damage and harm financial markets. This was precisely what happened during that time, on top of the instability geopolitically that also added to that pressure too. So, I'm still bullish on oil, and I'd rather be bullish on oil than NASDAQ. And so I think there's a reason to be adding capital there as well.
What about the U.S. 10-year yield versus WTI oil prices chart? Could you give us some more color on this?
Yeah, I think that the 10-year yield recently we've had which almost sounds like manipulation, the amount of it has rallied recently. And so the 10-year yield chart has really changed over the last week or so. Everything has changed over the last week or so. So I want to point that out. I mean, things have truly, we just got new information about something we didn't have. And so this new information, some things are valid, some moves are valid, some moves are less valid, meaning overall equity markets rallying a couple of days ago was probably not the right move. I mean, if there's, so much risk in the economy in general, maybe there is a potential for further pressure to the downside of most risky assets. The Treasury move is interesting because while Treasuries are rallying, you're not seeing corporate bonds follow the same pattern. So you're seeing credit spreads blow out, which means higher risk being priced in the markets right now. I think the overall trend for 10-year yields is higher, not lower. So if I'm an allocator and I'm looking for opportunities after this recent volatility, I think the 10-year yield poses an opportunity where you think the 10-year yields will keep rising. I believe that can be the case. And the reason for that is because of understanding that the government will have to issue more treasuries. And it's not going to be a small amount. And that amount will likely drive the dynamic of supply and demand mismatch to occur again. And if that's the case, 10-year yields should be, again above 4%, which are now below that. And so I think that's, in a way, an opportunity right now as well. I think I usually like these types of markets when you have this kind of big moves and everything gets whacked and you're just looking as an investor to see what are real moves here and what are moves that maybe shouldn't be justified. And those are usually opportunities. And so that's kind of discerning those moves is very important. And that's what I've been doing a lot right now. And I think 10-year yields are in that camp or in that category of things that are not making a lot of sense to me.
Okay, so let's shift to the Brazilian equities versus commodities producer chart. Why should investors pay attention to Brazilian stocks?
Because if you're in a bullish commodity environment, you want to own, in my opinion, institutional capital will chase the market and will likely look for diversification in commodities. The commodities market is a very relatively small place to invest. And if you try to spread your wings into this space, it is only logical that they would expand their exposure to a very natural resource rich economy like Brazil that is very cheap, fundamentally speaking. And therefore, also, I should point out that performed very well during the 70s relative to overall equity markets in the US, and how emerging markets today are seen as a block, but really shouldn't be seen as a block because the Brazilian economy is just so different from Russia from a geopolitical perspective, from China, because it's a net importer of commodities, not an exporter, from India for the same reasons. And so Brazil plays a role here into being exposed to agricultural commodities, energy, metals and mining. And it's just hard to believe it won't attract an influx of capital as we see a market that is more favorable to commodities over time. So that's why I think that's a relevant place to be deploying capital today.
Okay, so Tavi, we can't let you go without talking about precious metals. What is your read on the recent price action in gold?
Oh, very bullish. I mean, I think that the theme for the next months will be this gold to S&P 500 ratio, where gold continues to outperform the S&P 500. With volatility, there will be months where this ratio will fall, but overall, it's extremely bullish to be an investor in that ratio. And ultimately, if that ratio works, you would expect that other parts of the precious metal space would also benefit, including silver and the miners, which has been the case recently as well. So I'm very bullish in everything in that front. I think it's required to have some hedging with the overall equity market. But after you see yield curve inversions shoot up to levels we've seen recently, that tends to be extremely bullish for this ratio. And I continue to think that we're going to see the gold to S&P 500 outperformance over time. And it's going to be an incredible opportunity. So I'm very, it's one of the highest conviction ideas we've had right now. Because empirically, every time we had yield curve inversion shoot up above 70%, this ratio performed very well. And so I like to use those historical analogs to help me construct a portfolio. And it's precisely what this is. It's high. It's difficult to not have a high conviction in this when you know that historically yield curve inversions not only cause recessions at some point, but also cause precious metals to outperform overall risky assets, particularly equity markets. So,
Okay, Tavi, well, that's all we have for you today. Thank you so much for coming on and sharing your expertise with us and our audience.
thanks for having me. Appreciate it.
To our viewers at home, thank you so much for tuning in today. We will be back again tomorrow, so be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.